Okay, we are going to start Chapter 9, Long-Term Assets. The first one is exercise number 1, and it just reads here, Costs of Acquiring Fixed Assets. So what we're looking at here is a list of items, and do we or do we not consider it to be a part of the cost of that printing press? Letter A, it's do these costs incurred acquiring a new printing press, should they be debited to the asset account? And letter B is, should they be debited using for the used printing press? So let's look at the first 1 through 6. That's with the new. And what we're looking at here is, are there any costs that really should be expensed versus capitalized or debited to the asset account? Fee paid to the factory representative for installation. Absolutely. Freight. Yes. Insurance while in transit. Yes. New parts to replace those damaged in unloading. Well, if those parts were already there and bought once, we don't buy them a second time because let's just say, for instance, you bought a car that had a headlight, and as it was unloading, that headlight got damaged, so you put another one on. Well, your car doesn't have an additional headlight. When you look at the total cost, it still has the same number of headlights as it was always supposed to have. So number 4 would just be an expense. Number 5, sales tax, absolutely. And number 6, that special foundation, again, yes. So all costs incurred to get that asset ready for its intended use gets capitalized. Sales tax, insurance, freight. Very similar to inventory. 7 through 12 is on the used printing press. Fee paid to the attorney to review the purchase agreement. Getting it ready for its intended use. Yes. Freight. Yes. 9. Installation. Yes. Repair of damage incurred in reconditioning the press. It's a repair. No. Replacement of worn out parts. Well, we bought it used, and now we're replacing those worn out parts with new parts, so that's actually enhancing it, and that would be replacement of worn parts, that would also be added. And then number 12, vandalism, would be similar to a repair. In this case, we would submit it to insurance, but we don't add that to the cost. So in the used section, the used press, it would be 7, 8, 9, and 11. Number 2, determining the cost of the land. The ski company has developed a tract of land for a ski resort. Should the tree cutting, land clearing, and grading costs of constructing the ski slopes be debited to the land account? And the answer is yes, because it's getting it all ready for its intended use. And then they ask about land. Should that be depreciated? And the answer to that question, and that is the same answer for all cases, land is never depreciated. So even if there was a tornado that came through and wiped out the building, that land is still there. That doesn't go away, so we don't depreciate that. Number 3, on-time delivery company acquired an adjacent lot to construct a new warehouse, paying $90,000 in cash and giving a short-term note for $50,000. Legal fees $1,750. Delinquent taxes that we assumed that we had to take over $25,000. Fees paid to remove the old building were $9,000. Materials salvaged, so we had some materials that we could get rid of, sell. Materials salvaged from the demolition of the building were sold for $1,000. A contractor was paid $415 to construct a new warehouse. But the question says, what is the cost of the land? Okay, so in this case, we've got the purchase price, right? It's the cash and the note, the total. We paid some legal fees, delinquent taxes, demolition. So our total cost into the project for just the land is $175,750. We'll take away that $1,000 that we got for salvaging some materials. So our total cost of the land is $174,750. The $415 is for the building. We keep those separate. Number 5, straight line depreciation. Convert each of the following estimates of useful life to a straight line depreciation rate. It's important that we know how to do this because this is something that we'll have to look at down the road. It's very straightforward, as you read in your chapter. So like letter A, 4 years. Well, 1 divided by 4, 25%. Letter B, 1 divided by 8, 12.5%. 1 divided by 10, 10%. 1 divided by 16, 6.25%. Letter E, 1 divided by 25, or 4%. And likewise with F and G. So what we're trying to do there is get to a straight line depreciation rate. Straight line depreciation rate. Number 6, a refrigerator used by a wholesale warehouse has a cost of $82,000, has a residual value of $6,200, and a life of 8 years. So you take the cost less the salvage divided by the number of years. And in this case, we're just slightly over $9,000 of depreciation every year. So you take the cost less the salvage divided by the number of years. Number 7, depreciation by units of activity. So we've done straight line, now we're doing units of activity. A diesel-powered tractor with a cost of $120,000 had an estimated residual value of $16,400, and it's going to be used a total of 28,000 hours. So we will depreciate it based on how much it's used, not this ratably straight line 1/10 or 1/10 every year, but rather you use it a lot of hours, you depreciate it more. You use it less, you depreciate it less. So in this case, it comes out to $3.70 per hour. In the month of April alone, they used it 150 hours. So again, our entry for depreciation is always depreciation expense and then a credit to accumulated depreciation. And it's, in this case, for the month of April, $555. Okay? Let's move over here to number 9. Depreciation by 2 methods. Okay, so this tractor acquired on January 8 at a cost of $85,000, had an estimated useful life of 10 years. Assume that it has no residual value. And let's make sure we understand what residual value is. It just says that when we're at the end of its life, whether it be 10 years, in this case 8 years, we believe there will be some value yet. It might be totally shot, but that metal, the steel, whatever on it, would still be worth about $1,000. So we would depreciate all of it except for $1,000. Now in this case, there is no residual value. Determine the depreciation for each of the first 2 years, straight line, and now we're talking about double declining. So letter A is first straight line. Well, straight line. So in this case, cost of $85,000, 10-year life, $8,500. Second year should be the same amount again. $85,000 divided by the 10 years, $8,500. So that's how we work straight line. It's always the same every year. And in this case, it is the same because we bought it at the beginning of the year. So it both had the full year. Now let's talk about the double declining balance method. And this kind of goes back to number 5 up here when we were looking at all these rates. Okay? So in this case, we had a 10-year life. So a 10-year life is 1 divided by 10, or 10%, times, and then double it, double declining. So now 10% becomes 20%. If it had a 4-year life. 1 over 4 is 25%. Double it is 50%. Okay? So in this case, in year 1, we have 85,000 times 20% or 17 grand. First year is very straightforward. Second year, we take our 85, remove the depreciation we already took, and take it times 20%. So 85 minus 17 times 20% is 13.6. If we were to do it for year 3, you would take 85,000 minus 17 minus 13.6, and then that number times the 20%. Okay? So that takes care of number 9. Let's get number 11. Partial year depreciation. Equipment acquired at a cost of $105,000 has an estimated residual value of $12,000 and an estimated useful life of 10 years. It was placed into service on May 1 and ends on December 31st. Determine the depreciation for the current fiscal year and for the following fiscal year using straight line and double declining. So in year 1, first you take your cost minus your salvage, and then it was May. We bought it in May. So May, June, July, August, September, October, November, December is 8 months. So we take 8 over 12. That year we had it for 8/12 of the year. And then, oh, excuse me, I missed a step here. So 105 minus 12, there is your cost that you're going to depreciate it, divided by 10, because there's 10 years, a 10-year life. But then this first year, we're only going to take it 8/12. Okay, so 105 minus 12 divided by 10, and then take it times 8/12, or 6,200. In year 2, we don't need to do all that calculation. It is just 105 less the salvage divided by 10, because in year 2, we will have it the full 12 months. It's year 1 where we only had it for 8 months. Letter B is double declining. All right, so once again, double declining. In double declining, there's something also that we need to notice. In double declining, we do not pay attention to salvage value. We do in straight line, we do in units of production, but we do not for double declining. That's something you just have to make a note of. So in year 1, you have your $105,000 asset. It's a 10-year life, so 1 divided by 10 is 10%. Double it, 20%. And again, we take it times 8/12 of the year. Okay? Notice we got more depreciation. Year 2, 105 less the prior year's depreciation times 20%. We don't have to do the 8 over the 12 or the 12 over the 12 in this case. So 105 minus 14 times 20%. In year 3, if you were to do that, it would be 105 minus 14 minus 18.2 times 20%. The only thing you got to be real careful with when you're doing the double declining balances, you got to be careful when you get to the end, when you get near the end of its life, its 10-year life, that you don't also depreciate the salvage value. So you got to just know in your head that you have to stop at some point to keep that 12,000 of salvage value. And then number 13, and then we'll take a break. It just says this freight line incurred the following costs related to trucks and vans used in operating of its delivery store. Classify each as a capital expenditure, which is where we debit the asset account, or a revenue expenditure. And in other words, we're saying what is an expense. Okay, so number 1, change the oil. Of course, that's an expense. Change the radiator fluid, expense. We put a new lift on, that we capitalize. Installed security systems on the new truck, capitalize. It's new. Number 5, overhauled the engine. Well, essentially, that's a brand new truck then from an engine standpoint, so we capitalize that. Rebuilt the transmission. Again, extends the life. Capitalize. Removed a two-way radio and installed a new radio. We would capitalize that. Repaired a flat tire. That's an expense. Replaced a truck suspension system. It's a whole new system. Capitalize. Tinted the back and side windows. In this case, they capitalize it. From a practical standpoint, many companies look at a lot of these items from a dollar standpoint. So if it's, tinting these windows and it was $250, they would just expense that because we don't want to maintain records showing that we capitalize that and then we have to depreciate it. When we're talking $250, it really doesn't matter one way or the other from a practical standpoint. So we'll stop there for a moment, and then we'll pick up the rest of the Chapter 9 exercises shortly.